Okay, Anthony, we get asked all the time, when do you use corporations? Is it better to use corporations? Do you buy properties personally and then graduate to using corporations? How does this work? So I'm just going to start sharing some information, and then if it's confusing or I haven't explained something clearly, you jump in and let me know. Good
Sounds
plan?
good.
Okay.
Let's do it.
So if you're going to use corporations in Canada, the first thing to keep in mind is that you need a good team of professionals that understand real estate. So if you're an accountant, you can have a great accountant and a great lawyer, but if they're not real estate specific accountants and not real estate specific lawyers, we've learned over the years, they just don't know the answers to some of these questions. They just generalize their answers. You really want a real estate lawyer. So what that means is somebody who spends a big part of their career dealing with real estate investors, either beginner investors, people who are big investors or developers. They just need to be involved in real estate. And your accountant needs to be familiar with people owning real estate as assets. If they don't have that knowledge, you're just not going to get the insights that you need to set this up properly in Canada. And it's a big deal. So that just first step, keep that in mind. And then before we talk about owning properties in corporations, I think it's important for anyone who's getting involved in real estate investing to understand why you wouldn't. Because holding properties personally, I jotted down a couple notes here. Holding properties personally is advantageous because when you're starting, all the banks will qualify you. Every bank in Canada is going to have some real estate investment mortgage product that they will qualify you for.
But if you start with a corporation to buy your first few properties, will they not also qualify you?
So if you start with a corporation, okay, let me get these two other points with personal. I'm going to answer because that's a great question. So qualifying is easier personally, and for liability reasons. If you get insurance, we used to get $1 million insurance per property. Then it was our lawyers kind of advised us at $2 million, and now it's $5 million. That's just recent where they've said, hey, per property, get $5 million liability. So I would talk to your lawyer about the right liability insurance. But if you have the proper insurance on a property, a lot of people's concerns about liability kind of go away. Because if you have the right insurance, if it's like a declared rental property with the proper insurance, you're kind of covering yourself from a liability point of view.
Is that just inflation driving up that insurance coverage that you need?
I think it's both. I think it's a combination of inflation, and we in Canada, unfortunately, are entering a little bit more of a litigious society, kind of mirroring what the US has done over the last 10 years.
It's just getting more lawsuit happy.
A little bit more. Thankfully, I think I'm not an expert to advise on that, but I think we're just not there yet. But I think it's a bit of both, inflation and just a little bit more litigious stuff happening in Canada. So $5 million insurance. But that's definitely something. Don't listen to us. Talk to your lawyer. They are the best people to be explaining that to you. And then, the last thing on the personal stuff is taxes. There's tax advantages to owning properties yourself. And we're not accountants, but we've owned real estate for a long time. So we can tell you that when you have expenses on your real estate, you can deduct that against your personal income. So if you're earning T4 income here in Canada and you have expenses, on your rental properties, those expenses can be deducted against the rental income. But if they exceed the rental income for any given year, let's say you had like a big renovation project or something, or a big maintenance requirement on a property, you can make those deductions and they can go against your personal income. You might get tax rebates at the end of the year on your tax return because you have these expenses. And you need to talk to an accountant about that because some of your expenses in real estate can be deducted in its entirety, all in the year that you're having the expense. Some have to be kind of amortized over a few years. And I'm not going to talk about that here today, but personally, it can be advantageous to own real estate in your own name because of those expenses.
So you mentioned if you're a T4 employee, you could potentially deduct like maintenance expenses, other expenses you have for your property against your personal income. What if you're self-employed? Can you still do that against your personal self-employed income?
Yeah, I should have been more clear. You're right. You totally can. Yes. I was thinking a T4.
Just personal income.
Yeah, your personal income. I was thinking T4 because people who are, earning T4 income, the government always taxes you at pretty much the highest rates here in Canada. So if you're earning T4 income, you almost want other expenses to have deductions against that income. But you're right. If you're self-employed, it's the same thing. When you file your tax returns personally, there's a form where you outline your rental properties. and all the income and the expenses. And even if you're doing it as a joint venture, on that form, it will say what % ownership of this property you have. So if you have a 50% ownership, you can put in 50%.
So then is income and expenses split? Like let's say it's 50-50, the JV?
Generally, it's whatever the split is, whatever you put down on that form.
Okay. So
Right.
you would report half of that income?
You generally report everything,
Okay.
and then you just share.
Say 50% ownership.
Correct.
And your real estate investing expert accountant can deal with it.
Yeah, they'll deal with that.
Okay.
Yeah, exactly. And every accountant likes to have their own kind of tips and tricks on how they report things. Like we've learned that accounting is kind of an interpretive thing. Like everybody interprets the CRA and the Canadian Revenue Agency in different ways. So they file their taxes or report things slightly differently, all legal, but they all kind of do it their own way. So yeah, you need a good real estate
Just to make it more fun.
Yeah, to make it more fun. But a good real estate accountant can really do some wonderful things. So it's useful. So personally, there are some advantages. To just recap, you qualify for the easiest and with all the banks. And we'll get into the corporation thing. Liability, as long as you have the right insurance, you're talk to a lawyer, but in our opinion, you're covered. And from a taxes point of view, it can be advantageous to have rental properties because you can have extra deductions against your income. But now just transitioning to corporation. So you asked about qualifying. Right. And what was it? If you can qualify or.
Yeah. Like if you wanted to start out to buy your first real estate investment property, could you still qualify through a corporation the same way that you can qualify personally?
Yeah. Okay. So we learned this the hard way. So there's so many answers to this, but if you're starting a corporation just to use that corporation for your real estate investing and you're just beginning, no bank in Canada is going to use that corporation all by itself to qualify for the property because that corporation has no history of income and expenses. There's no financials. So you can use the corporation, and some banks in Canada will allow you to close in that corporation. So this is the first negative of using corporations. Not all banks will allow it. So if you're buying a rental property, some banks will have mortgage products for you they will only do if you close in your own name. Other banks will allow you to close in a corporate name, even if it's a new corporation, but you're going to have to personally guarantee that mortgage. So even though you're using a corporation, it's closing in the corporation, you're going to declare taxes and all the revenue and expenses for that property in the corporation. You're still going to have to personally guarantee that mortgage. So now you have less mortgage options in Canada, and you're still personally guaranteeing. So it's not like the most fun thing to kind of go through.
Okay.
But people like it because there's a perception that my liability is contained, and there is some truth to that when things are in a corporation. And this is again where you need a lawyer, but they will say that if anything happens to your real estate properties, it's contained within the corporate seal, and you have less liability. You still need the proper insurance on the property, absolutely. But people just kind of like that. It gives them the warm and fuzzies that it's in this corporate structure instead of holding it personally.
So how much truth is there to the statement that it does protect you from liability versus just gives you the warm and fuzzies?
No, I think it does. And lawyers will argue about this. Okay. But, and we're not a lawyer, but as far as I'm concerned, in 90% of everything I've ever heard is that there is truth to that. It will be contained in the corporate seal, and if anything happens and there's a liability issue, nobody can come after you personally.
Okay.
But again, I just want to repeat, you need to talk to lawyers about this because they argue about this point, and we're not lawyers. And then if you get the right insurance, you're also then covered with the corporation as well, and the insurances should still be on the property.
From a potential lawsuit?
Yes.
Okay.
But you have to personally guarantee the mortgage still. So a lot of people start using corporations and they're like, well, the corporation's going to buy the property. Well, you still have to qualify personally because that corporation that you just started has no financial history. So you have to qualify personally, or if it's 2 or 3 of you owning the corporation together, you might have to qualify as a group, or one of you is going to have to take the lead, but someone is still qualifying. And then you're still going to personally guarantee. There's no bank that we're aware of that is going to not have you personally guarantee the mortgage on the property, even if you are closing it in a corporation and even if the mortgage is in the corporate name.
A lender and B lender? That's the case?
We've never seen a lender not require it. Okay. Every lender, private, B, A, they all want to make sure they're getting their money, and they want a personal guarantee from you. That extends to beyond a single family home or a single condo or single townhome rental property. Even when you're looking at commercial real estate, you're going to be personally guaranteeing. The only difference there is sometimes you can negotiate the terms. So if you're buying a bigger apartment building and you're going to use a corporation to hold that one apartment building, you're starting a new corporation up and you're going to close the financing inside that corporation, you have some leeway with the banks to negotiate the terms on how long you're going to personally guarantee for, how much you will be maybe liable for, because some banks will actually allow you to negotiate that. Like after 5 years on a 25-year term, maybe you're not responsible for everything anymore personally if things go bad with the mortgage, and you can dial down your responsibility. So you can negotiate the terms on that. On smaller properties like a single family home rental, you're generally not negotiating those terms.
So is that because with the commercial properties, the bigger ones, it's more led by income and there's more maybe income being generated that gives you that kind of negotiating power to do something?
Yeah, I wish the banks were that clear with us. They have never come out and told us why.
Okay.
It's just we've noticed that when it's bigger properties, you can negotiate your personal responsibility on that mortgage a bit. Whereas on the smaller stuff, they're just like, I think it's just more volume. They're just like, hey, it's a single family home. It's a single condo rental. Here's the terms, take it or leave it. But on a bigger deal, there's just more skin in the game for them. This is like a bigger, meatier mortgage. It might be a property instead of, let's say, $1 million condo. Maybe this is now like a $5 million thing or a $10 million thing. It's just more interesting.
It's almost like a business loan versus just kind of run-of-the-mill mortgage.
Totally.
Yeah.
But you're just always going to personal guarantee, and in any situation, we've never seen it not happen, even if the corporation is active already. So if, let's say you have a corporation that's doing something in business already, it's already active, you're already running some property management from this corporation, or you have, you're a graphic designer and you run your own business and you're running a corporation, you want to use that corporation to buy this property, and that corporation already has a history of financials that are, tax returns and everything, you're still going to be personally guaranteeing. We've never not seen the case. And I'm sure someone's going to call me out on that and say, there's this credit union that did this once for me, or this bank once. And there are exceptions always in banking, we've learned, but in general, you're personally guaranteeing. We've never really seen it en masse or in a big way that you're not. So just something to kind of keep in mind on that. And then on the taxes, if you hold a property in a corporate structure, in a corporation here in Canada, it's considered passive business income. And it's taxed at that rate. And I don't want to date this video, so we'll just say it's high. It can be somewhere between 40 and 50%.
Passive business income.
Yeah, the tax rate on passive business income. It's really high.
How is it treated if it's in your personal name? Active, income?
It's just income. Yeah, just whatever your tax bracket is.
Okay.
Yeah. So the rental income is just treated as income. You're going to have personal income.
Okay.
It's your personal tax return. But at the corporate level, property is considered passive business income, and it's not taxed at the active business income tax rates. So for example, here in Ontario and in Canada, if you have a corporation and you have a net income of $500,000 or less, or let's just call it on the first $500,000 of net income. So you could be generating millions of dollars with your real estate. You did amazing. You have millions of dollars of rental income coming through up on the first $500,000 of net income. So after you've taken all your expenses, your deductions, you're taxed right now at 12, and it's about 12.5%. So again, we're not accountants. Check with your accountant, and that always adjusts a little bit and changes.
But sorry, that's the active business income. So then wouldn't real estate rental income not qualify for that because that would be passive?
Correct.
Okay.
It doesn't qualify for that, but some accountants will help you set up other corporations that are genuine active businesses.
Okay.
And then as part of that genuine active business, perhaps you're doing some work for your corporations for your real estate that's owned in another corporation at fair market value. So let's say you're managing the property and you're going to invoice your real estate corporation for property management services at fair market rates. You can't just say, oh my God, I'm the best property manager ever, and I'm just taking all the income from that passive business, my corporation, over to my active business. But you can invoice and pull some of the money from the passive business income into an active corp that's being taxed way less. So this is where you need good accountants, because they will look at your life and say, okay, Anthony, you know what? You have a few properties already. You have this other side hustle that you're doing. It's a business. We can set things up like this to have a more tax efficient structure for you. And we're going to kind of move some of the money around in a legal way, do it all properly, CRA kind of approved. But you need to have those discussions with an accountant, because if you just leave your income in one corp, you're going to be taxed at passive business income levels, and it's not going to be the best tax rate at all, especially when there's a tax rate of 12.5% or so. It's always changing a little bit. I know it might be 12.2 right now, but let's say 12.5. And when, depending on when you're listening to this, if you want to talk to your accountant, but that's a really great tax rate. And that's up to a net income of 500,000. So you could be running a huge business, and you know, anything that's 0 to 500,000, you're taxed at that rate. And then after 500,000 in net income, you're taxed at the regular business corporate rates. And then you're up at like whatever it is right now, 26, some of it's like 36, something like that. And it goes kind of higher.
Is this money taxed if you take the money out of the corporation, or is this just taxed in general to corporate earnings, even if you just keep all the money in the corp?
Yeah. So even if you just keep all the money in the corp, you're paying tax just like you would pay tax personally.
Okay.
And then if you take the money out of the corporation, so now let's say you're a real estate investor, you set up this awesome multi-corp structure to be the most tax efficient as possible with the help of your amazing accountant. And you say, well, I want to buy some steaks for the barbecue. I need some money personally. When you take money out of the corp, that is now taxable personal income.
So you get taxed.
You get taxed again. And a good accountant might have strategies for you depending on your life and your family and your structures, that maybe it'll be dividends. So it's taxed at a dividend rate. But it might just be personal income. And accountants will often use the language that it's like a blended rate, that, you know, you're never really getting ahead. Whatever you're taxed in the corporation and then you're taxed personally, it all comes out to the same kind of rate that if you were just taxed personally. And we won't get into more depth there, but you just want to talk to an accountant, because any money coming out of the corporation or the corporate structures, you're taxed personally. So you're taxed in the corp, and they're taxed when you remove it. But it's why a lot of people, if they're staying in real estate over long periods of time, do want to start using corporations, because the tax efficiencies in the corporate structures are a little bit better. Nick and I can tell you that from experience that they are. And then you want to leave kind of as much money in the corporate structures as possible, because if you take it out personally, you know, if you're all into, like, I don't know, buying cars and Rolexes all day, and you just like want your money, or, you know, for me, just, I want some nice steak for the barbecue. Yeah. You're going to be taxed on it. So you just want to not take more money than you need out of the corporate structure. And your corporate structure ultimately becomes your piggy bank. That's where your life and savings resides. And you can do other investments through there.
I was about to say, you can still use the money just for investment purposes and continue to grow it just within that corporate structure.
Correct. And sometimes your accountant will get you to introduce a corporation, and you'll move money up to a holding corporation that's not an active business, just for another kind of layer of protection, where you're extracting money out of your active businesses, moving into a holding corporation. Again, talk to a lawyer and accountant about this stuff. But then your holding corporation might lend money back down to your active businesses to buy another property. So one business is getting the benefit of, you know, money from another business, and then maybe they're paying that business interest, and it's an expense to that business. The other corporate structure is earning income by lending money out. So within your own corporate structure with multiple corporations, you could be kind of playing bank a little bit. And it takes a little while to set this multi-corp structure up. But you just need good accountants for that. Okay,
so when does it make sense? Like I bought my first 3 properties personally. They're all with joint ventures, so it makes it a bit more tricky. But let's just say it's a husband and wife, like typical, maybe people who come and work with us at Rockstar. They buy a couple properties. They decide, hey, I like this. I want to, you know, stick it out for the long run, continue to build my portfolio. When does it make sense to be like, okay, I'm in it for the long term. I want these benefits. Like, when is it worth it?
So I think we did it wrong. We just did it out of the gates, and it was wrong because we had to, like, the corporate tax returns, a corporate tax return, even if there's zeros on it, which I think we started a few corporations because someone told us to, and it was kind of like too early. They were like $700 each to do a corporate tax return. So we started printing stuff off and just putting zeros on everything ourselves and filing them. So, like, what we tell everyone is, like, lead with revenue. So to start every corporation, depending on the lawyer you use, is going to be, I don't know, something from like $1,000 to $1,500, depending on where you do it. And you typically want to do it with a lawyer, do it properly, and not like online and, you know,
Like make your own corporation kit online.
Yeah, I would go to a lawyer that you like and start developing that relationship and getting them setting up. And if it costs you a couple $100, it's just better. You have a relationship, you can ask them questions because now you're a client. It just works better. That's our opinion anyway. But then you would lead with revenue. So you would need enough money from the real estate investments to pay for the initial setup. So if you're going to do one corp, it's at least $1,000 to $1,500 to set up the corp. And then you have annual tax returns from at least $700. If there's a lot of stuff going through the corp, it could be $1,000, $2,000, $3,000 for a corporate tax return when you're starting out, but at least $700, I would say. Some accountants listening to this probably going to hate that I'm putting out numbers, but something like that, like $1,000, could be higher. So if the real estate portfolio is not generating enough to just pay for the corporate setup and then the annual tax returns, hold off. But once the real estate portfolio is generating enough income or
profit,
enough income, or there's enough equity and appreciation in there where you're like, okay, you know, maybe on straight cash flow, I don't have that, but I'm now really building some nice equity in this portfolio. I will spend the money. But if you're really tight, like if you're just starting out, there's not enough revenue to pay for the corporate setup, because remember, the corporations are going to need their own bank accounts. Those bank accounts at TD or Royal Bank or BMO, wherever you're going, are business bank accounts.
Yeah.
Business bank accounts have fees.
Yeah.
So
higher than personal bank
Higher than
accounts,
personal.
right?
So now you have business bank account fees, you have legal fees, and you have accounting fees at the corporate level. So we just tell everyone, until you're at least 2 or 3 properties and own them for a couple years, it probably just doesn't make sense. But after that period, you likely have enough equity or some cash flow starting to get a little bit better on those properties because you've owned them for some time. Maybe you've had some tenant turnover, maybe rent's gone up, and just things are kind of flowing a little bit better. Lead with the revenue. When the revenue is big enough to pay for that overhead, then do it. And it brings us to another challenge with using corporations. If you've qualified for things personally and you want to move them into corporations, you have to sell them to your corporate structure. That triggers some tax things.
Land transfer tax?
Land transfer tax. It also, if you bought it at $500,000 and let's say it's worth $600,000, or you bought the property at $800,000 and it's worth $1 million, well, you can't just transfer that over and not pay tax. There's a difference there. And in the government's eyes, you've sold a property because that corporation is a different entity. It's not Anthony anymore. Even though Anthony might own the corporation, it's changing ownership. And now someone has to pay tax on that gain. This is why you want to sit down with an accountant and lawyer who know what they're doing, because usually what people do is they get their first property or first 2 or 3 properties personally. And then after that, they use the revenue from those properties to set up the corporate structure, but they use the corporate structure for all future purchases. And those first few properties kind of stay in their personal name. Forever until you sell them off because you're doing something with your portfolio or something. But to transfer them in, and many people have, but it's difficult to do it in a tax efficient way because of what I just mentioned on, you know, you're effectively selling them with the land transfer costs and possibly some gains.
Would you ever put your personal home into your corp once you have it set up?
Yeah, some people do, and I think it's just like a case by case thing. Most people don't. There are some like advanced strategies that for today we'll leave them out, but that would be good to talk about in the future. But I'd say most of the time, no. But as you accumulate a certain amount of kind of wealth in your life, some people do that, or they're purchasing their family home in a corporate structure. But yeah, we'll leave that one for another talk. There's some things to think about there. And again, if you're listening to this, all of this, you just definitely need to speak to a lawyer and accountant. This is just our opinion after going through this for years. I think we've covered most of anything else coming to mind?
No, that's it. I think I need to maybe start a corporation for the next few, because I'm definitely in it for the long run now.
Yeah.
So.
Yeah. Cool. Thanks, Anthony.
Yeah.